Good morning. Good morning.
Good morning.
Morning.
I'm Cheryl Spivey, the city CFO, and in council's opinion, since we do not have a chair or vice chair, I'll run the meeting this morning until such case as we have a chair and vice chair. And so we'll begin with the roll call.
David Harrington.
Here.
Herman Covey.
Here.
Mark Gardner.
Here.
Landon Moore.
Here.
Mark Munson.
Here.
Laura Bellin. Holly.
Here.
Derek Challenger.
Present.
Solomon Ashby.
Here.
Elizabeth Gooden.
Present.
Cheryl Spivey.
Here.
You do have a quorum.
Thank you. So the first business is introduction of our new members. So we did have 3 members roll off the board very recently. Matthew Crutcher, Sue Burton, and Gary Waters. And Mr. Covey, would you like to introduce yourself?
Good morning. I'm Danny Covey. It's obvious I work for the police department. And I am very honored to be part of the board.
Thank you. Mark Gardner.
I'm Mark Gardner. I'm the retired Director of Information Technology. Been retired for a little over 5 years now. Enjoying life and appreciate all the work you are doing to sustain the fund and the system.
Thank you. And David Hawley.
I'm David Holly. I have a wealth management investment firm. I have been looking forward to serving on a committee with the City of Portsmouth for a number of years and welcome the opportunity to do so.
Thank you. All right. Well, welcome to all 3 of you.
Thank you.
So next on the agenda is the review and approval of the minutes. Does anyone have any comments on the minutes that are included in the packet?
No questions. I move to approve them.
Second.
All in favor?
Aye.
Aye.
Okay. So at this point, I guess I would like to see, if we can change the order of the agenda so that we could move number 7 up. Would that be acceptable to everyone?
Sure.
And that's the discussion of the election of the new chair and appointments to the investment committee?
Right.
Okay. I guess the first thing is, is the board interested in going ahead and selecting a new chair today, or would you prefer to wait until the next meeting? Have any thoughts?
I don't have a problem with going ahead and electing the chair.
No objection.
I have no objections of doing that.
Okay. Does anyone have a nomination for chair?
We have a lot of new blood, so I mean that would be great if somebody that's going to be here for the next 4 years would step up and take over. I know Laura has been the vice chair. I don't know if she has any interest in stepping up as a chair since Sue is off. Have we?
She didn't say anything to me.
And if I might, I'm not certain what Ms. Bellin's intentions are, and I think that's why I mentioned to Ms. Spivey early on whether or not you as a board wanted to make that decision this month or next month. Certainly that requires some caucusing, and I believe we have a means over the next month to address any kind of transactional events. But of course, with Ms. Bellin coming off as chair, there is a need to replace chair, and that may, depending on your decision, create an opening in the vice chair position, but that is an issue for you all to ponder and consider.
Was Laura, she is the vice chair, or she
Correct.
was?
That's correct.
Okay, and how long is her term?
I don't have her, I can certainly get that for you. I can give
More than a year, you know?
I believe so, yes. I believe it is.
I would personally have no problem with postponing the election
Until she's here,
huh?
until she's back.
Until, you know, if she's interested in moving into the position of the chair. David, I understand what you're saying about the new blood and being here, but I think in all fairness, to be chair, you should have some experience on the way the board is operating.
I agree.
And I would have no problem with postponing the election of chair and vice chair until the November meeting, yes.
I would agree with that. I think it's important to have somebody who understands the protocols and the operations of the
Right.
board, and serving as vice chair, she certainly would know that.
I just
So-
found out she's on, her term expires in 2020,
Okay.
so she's got another 2 years.
I agree.
And if she's interested, it kind of makes sense to me anyway.
Yes.
Thank you. I'll ask Ms. Mosher to go over the items. Item 5, applications for retirement.
I have both the report for September, which was canceled due to what I like to call the non-hurricane, as well as the October information. In September, we had 2 deaths. Susan Mateo, who was a fire and police spouse beneficiary, and Michael Garrett, who was a supplemental plan retiree, which is resulting in a 50% annuity payable to Mildred Garrett. And then for October, we had 3 more deaths. Glenn Keys, fire and police, 50% spousal annuity payable to Dimitri Keys. Wilbur Gavin, fire and police retiree, 50% spousal annuity payable to Ann Gavin. Hamlin McPherson, supplemental retiree, 50% spousal annuity payable to Dolores McPherson. Leaves us with 21 active fire and 15 active supplemental.
Did you also move to the business reports?
Again, I have both what would have been in last month's packet as well as this month's. For the financial report, I'm going to read from the August. For the benefit of our new members, this is always 1 month behind. So I will have September numbers in November, etc. However, as of the end of the year, we started with a beginning balance year-to-date, $219,110,313.57. We had interest income of $226,624.04. We had recurring benefit payments of $4,942,307.80. We had a realized gain of $112,239.81 and an unrealized gain of $4,739,647.31. Year-to-date, we have had a net change and increase of $136,203.36 with an ending balance of $219,246,516.93. This is a change from the same time as of last year of $8,355,189.98 less this year than the same time last year.
Any questions on the information that Ms. Mosher has provided? Any discussion? What is the status of the OPEB trust?
The OPEB trust, and yes, I did double check it. The July statement was much thicker than the August, but as of August 31st, 2018, the total net asset value is $3,149,550.87. for the benefit of our new members. We started this with $3 million in, I believe it was April.
For the benefit of the new members, will you explain what that trust is?
OPEB is other post-employment benefits, and what this is money that has been put into a trust to pay for the health benefits for retirees. Usually, to date, it's been paid just by the city out of pocket. They decided to take some money, put it aside for a trust, so that the money is there, is invested, and will be available for the retirees going forward.
And we do not invest that we put that with the state, is that correct?
Yes, it's with...
Virginia Retirement System?
No, it's not with VRS, but, and
It is a pooled trust. It is a pooled trust operated by a larger board where each participating locality has representation, but the requirements of the pooled trust is that we have to have a local entity oversee that also. And so state law provides that if you have a retirement board, your retirement board can act as the organizing board for that pooled trust. So it is a pool with other localities such as Harrisonburg. It's across the state where localities have combined their OPEB trust for the benefit of the largest scale of economy.
what I'll do is I'll pull the minutes from the meeting when we made that decision and send it to the new members.
Was there a discussion at one point about one of the members of the city of Portsmouth or our board being on that board?
I believe, and I'll check on that, because I believe there is some need to have someone represent or act as the representative on that particular board. That was a discussion a while back. But I'll report back to you all.
And then some accounting changes. So other post-employment benefits, generally accepted accounting principles have changed on the accounting for those, and it is effective for the year we have just completed, fiscal 18. So there will be some. What it did is the standards brought the liability actually onto the city's balance sheet. Before, for a number of years, we've been getting an actuarial study, so we know what the liability is, but it has not it was not required to be reported on our balance sheet. That has changed this year. So we're in the process right now in finance, working with our auditors, having our audit complete, and staff preparing the statements. So we don't have that information yet, but it's kind of a just an update to know that's coming. The amount in this trust is very small compared to the liability. I don't believe I've seen the actuarial study, but we will. But that'll be coming forward. So the city council decided for this most recent fiscal year that they would that the city would start funding this trust, and this is the money that's in the trust right now, with the intent to fund it some each year. So as Ms. Mosier said, what the city has been doing up to this point is just paying the claims in the administration on those as they incur, versus having a fund to pay the claims from. So more to come on that in the next couple of months.
I've got a question. Is it my understanding that the city pays medical cost of retirees?
It is
medical insurance?
It is closed. It is a closed. You call it a closed system?
No,
what do we call it?
No, it's not closed.
Oh, it's not closed. Okay, go ahead.
No,
Yeah,
we do pay. The city does contribute a portion towards the cost of retiree health
Of all retired Portsmouth employees?
insurance. That is correct.
I was
With
going to
the
say,
exception of-
what we need is we need a statement that shows, what we have, what the estimated actuarial liabilities are. And if I remember correctly, this is very similar to what I'm dealing with with OPEB for the school system. It is a small contribution that each employee gets that in no way meets the full cost of the retiree's medical benefits, but a portion of it. They can apply that towards a benefit that they wish to purchase, correct?
No.
No? It pays the full amount?
No, it doesn't pay the full amount, but
That's what I meant, yeah.
But I would tell you, it's more than a small contribution. It's probably a lot more than most people would think. The reason why is because the pool of employees that's in it for retirees is very small, and we don't have the pool consolidated where the active subsidize the retirees.
Okay.
Is this fund for PRS and VRS retirees?
That is correct, and fire employees.
Okay.
All right, any questions on that? Okay, then the next item of business is I guess we have an invoice that needs approval.
Yes. The next page, it is a invoice. As you can see, it's for the supplemental retirement system, Willie Allen death benefit calculation. It's more we had this discussion at a meeting several months ago. We have to pay the invoices no matter what. This is actually more for informative purposes to the board, to let you know what additional costs besides the retirement payments would be coming out.
Any questions on this invoice? The next item is a recap of the City Council Retirement Board joint meeting on September 24th. And sure.
If I might, I wanted to start off by saying, and before I defer to those members that were here, I wanted to start off by saying if anyone is in need of the slides that were presented at the joint city council meeting, please let me know and I'll provide those to the new members, because you can look at it online, but I will also provide you the actual hard copy of the presentation. As I said at that time, had we not had the storm, we would have had a bit of that discussion with you all in advance. But I will just simply say from staff's perspective, I hope we served you well in terms of representing what the board's position has been. And I must certainly say, and we've discussed this offside, that the board did in fact make a great representation to City Council. I think I can safely say sometimes when we try to express the issues with regard to the retirement board as a staff member, it is difficult for it to translate to some of our bosses, but you hopefully, and I think you did a great job in terms of presenting the issues, and I think you got a very good response from the City Council in terms of how we move forward. And if there's anything else I can provide based on what you heard or what was discussed at the City Council meeting, please let us know and we'll fill in any gaps we can.
I would be interested in getting those, is it a PowerPoint presentation?
It is, it is.
A copy of that if no rush.
And I'll step out when the presentation, I'll get it to you before you
Oh,
leave.
you don't need to do it.
I'd like to have that too.
Okay. Board members,
There were a few questions that the council had that seemed to me questions that were easily answered had we had the latest financial report in hand. Have you given that information back to City Council yet, the requests that they made?
we are assembling a number of those questions, including that particular one, to give them the slides, at least for the most recent, and we expect to produce that to them by the next meeting.
Okay.
Let me give you one other update. You will recall I believe Councilman Moody asked about funding levels for other boards. And I will tell you that I have reached out to all of the municipal retirement systems that are outside VRS. I've received some responses, and I will send that to you all between at the conclusion of this meeting, so you'll have an understanding. And I think out of 5 or 6 responses I've received, all but one, it has a funding level higher than we do right now. And the one that is below us is cash funded. And so I'll provide you more detail after the conclusion of this meeting.
And Mr. Ashby, I also pulled data from the comprehensive annual financial reports from the cities in Virginia. I'm not from Virginia, so going through the reports, I'm not. I pulled the information as I understood it, but you may want to take a look at that. I have a chart that has that information in it as well.
So we'll compare before we send out to you.
Super. Thank you.
Any other questions, comments, anything else the board would have us follow up from the joint meeting?
The next item is council board retreat report. I'm not familiar with that.
Typically, there'll be a summary that'll be provided and shared with the board as a result of that meeting and any conclusions. So there'll be a roundup on that particular matter. And I don't know if we had any other members attend. Mr. Moore, did you attend the council board retreat?
I did.
I don't want to take your, do you have any comments? Did you find it helpful?
In general, it was sort of an update of some things going on in the city, some development projects, financial status of the various funds of the city, things like that. It wasn't, specific to the retirement board or anything like that. So I mean, I just as a citizen of Portsmouth found it, pretty interesting and informative about what's going on in the city. And I guess there are slides from that could be shared if anyone wanted to. I don't know if that's
I will get
public
with,
info or not.
It was. I will get with the clerk of the city and have all of those presentations presented at the time. My office presented on 2 issues, the Conflict of Interest Act and the Freedom of Information Act. And so I will get with the clerk and make sure that all of the presentations, the PowerPoints from those presentations.
Yeah, the conflict stuff especially for the new board members is probably important for them to have.
And I believe you all probably have a VML packet already. Mm-hmm. But if you have a need or desire to have that presentation made at a board meeting, I will certainly make those opportunities available to you if you just let us know. All right?
What's the VML stand for?
Virginia Municipal League produces a booklet that covers the Freedom of Information Act and the COIA Act. More often than not, and you probably received it with your appointment letter, and it's a booklet that's a pretty easy read and guide on the issues of conflicts and freedom of information requirements. But if you ever have a need, interpretation, or issue, please feel free to reach out to my office.
Now, for I'm sure what everyone has been waiting for is our report from John Hancock. I'd like to introduce Mr. Thomas Hanley and Mr. Andre Stewart. And I'm going to turn it over to you for this presentation.
Thank you. Good morning again, everybody. Cheryl said my name's Tom Shanley. I work at John Hancock. I'm part of our strategic relationship management team. In general, I have responsibility of all the services that we provide to yourself as a board, to the city of Portsmouth that runs the plan, and most importantly, to all the individuals who are either receiving benefits or will be receiving benefits in the near future. I've had a relationship with the city for closing in on 10 years, and as always, we thank you and appreciate the business, and happy to be here. I generally come down for the quarterly investment review meetings, which are typically held February, May, August, and November. That's where Greystone will come in, and they're an independent investment advisor and will provide an overview of the portfolios. And then I do come down annually with Andre, as Andre's going to walk through the annual valuation update. So again, happy to be here. I just wanted to mention two other points. So we just updated, we have an authorized representative schedule that's attached to the custody agreement that's used to hold the majority of the investment and assets for the portfolio. So we just updated that, bringing on the new members. We don't require all new members' signatures, but what we do require is sign off on that schedule, just showing, who has authority and oversight for the retirement system. With Sue has historically signed those. With Sue stepping off, I'm not sure. Generally speaking, we would just need an individual that's listed already to sign for us to approve the new members. So I'm not sure how the city wants to handle that, but and I'm sorry, I know you stepped out of the room from
Signing documents.
Right. In accordance with the city code, the CFO can sign, but
Okay.
I don't know logistically whether you have that individual or Ms. Mosher on your documentation.
we don't. So
Ms. Bellin?
we do.
Okay, well
Yeah.
then we probably just need to reach out to her.
Okay.
in the interim.
That's fine. And in general, we're, on an ongoing basis, we sometimes need signature on investment decisions, et
Sure.
cetera. But, I know contracts with Greystone are also being finalized.
Right.
So, okay. And then
Hey, Tom?
Yes.
This is Brian Birnbaum, and Jim Whitney's with me from
Sorry, guys.
Greystone in Chicago. Given the discussion that was just had, I thought I'd ask the question about the Greystone contract. I know there's not a new board chair yet with Sue's departure, but Mr. Ashby, what's the best route to get the finalize and execute the new contract with Greystone?
We've already had that discussion with Mr. Ammons, and with the board's acknowledgement, Ms. Spivey will take care of that in the interim.
Terrific. Thank you. Thanks.
Is everyone okay with me signing the investment contract that was approved by this board a couple of months ago?
Yes. Yeah. All right. Thank you. And I apologize, Brian, didn't give you both a chance to introduce yourself. Did you want to do that, or have you had the opportunity to introduce yourself to the new members?
Happy to do that. Brian Birnbaum, Jim Whitney with Greystone Consulting in Chicago. As Tom mentioned, we're the independent investment advisors for the board. Both Jim and I will be in Portsmouth in early November, and we look forward to meeting the new members. But in the meantime, if anybody has any questions, we can certainly circulate our emails and phone numbers, and happy to talk before the meeting coming up in a few weeks.
Great. The other thing I can share with the group is an overview we provided at the beginning of the year. We'll probably do something similar in February that just quickly goes through all the services that we do provide to give the new members an understanding of, in depth what John Hancock is doing. So there is a PowerPoint presentation that can be shared there. And one follow-up item now that the new members of the board are here, and I'll wait until the chair the new chair is elected. But I know I've discussed a couple years ago, we provided a fiduciary training session that came in and, talked about what does it mean to be a fiduciary, what is the role of a fiduciary, best practices, et cetera. So we're happy to do that again. Someone from our legal and ERISA team would lead that, and, happy to talk through some of that prior as well if you had interest in seeing what that material was. But we can follow up and discuss a time, hopefully, to come in maybe to do it during one of these meetings. All right, so with that said, let me turn things over to Andre, and I do want to apologize that the presentation, we had a little slight printing issue with our production room, so some of the pages are flipped. We'll just have to rotate as Andre goes through the material, but Andre's been with this relationship from the beginning. Essentially, he did step out. He manages the actuarial team at John Hancock, so he stepped out for a couple of years. We had another actuary that worked with the city during that time. When that individual left the organization, Andre came back in and has, again, been working with the city for the past few years. So he has a great history with the retirement system. So, Andre.
Thanks, Tom. Good morning. My name is Andre Stewart, as Tom mentioned. I am the actuary for the retirement systems, preparing most of the financial information specifically to contribution requirements as well as accounting information that goes into the CAFR. And as Tom mentioned, do want to apologize for the little bit of a workout we're going to get as we rotate these slides due to the juxtaposition. Want to keep this discussion as collaborative and as conversational as possible, so please feel free to jump in with any questions as I review the information. So I thought it might be of benefit to some of the newer members to just kind of start with a brief discussion of what the overall structure of the systems is. The effective date for both of the systems, fire and police and supplemental, goes back to the 1950s. 57 for the fire and police, and supplemental back to 53. Participation was frozen in 1995 for the fire and police system, and at the end of November of 1984 for supplemental. So when we talk about a participation freeze, that means any new employees do not come into the system and benefit, but the folks that had already entered the systems, they continue to benefit by receiving increased benefit amounts earned by their service. The benefits are provided in connection with normal service, which we might refer to as normal retirement. Also in connection with disability related to an employee service, or disability not necessarily related to an employee service. And then in connection with an ordinary death or death in relation to a member's service. Specific to the fire and police system, the members are eligible for a benefit after 20 years of service or at the attainment of age 50, assuming they have at least 5 years of service. The benefits are based on the final average compensation that the member has received, and that is an average of the highest 36 consecutive months that have been earned during their employment. And the benefit is based on a percentage of that final average earnings, and the percentages are linked to a specific time period. 3% of final average is earned for each year for the first 20 years of service, 2% for the next 5 years, and then 1% for any years of service after 25. So you can think of it as 60% of income is replaced after 20 years, or 70% after 25 years. In addition to those normal retirement benefits, there is a supplemental benefit for those who retire prior to 65 of $200 per month, and that benefit is paid up until the age of 65. With respect to the supplemental plan, there's no retirement due solely to service, but similar to fire and police, a participant can retire at the age of 50 with 5 years of service. The benefit is also based on the highest 36 months, the average of the highest 36 months, or what we refer to as the final average compensation. And the multiplier is a flat 2% per year of service, irrespective of how many years of service are earned. Prior to 2013, there was a recalculation of the benefits at age 65. So if a person retired prior to 65, the 2% of compensation applied. Prior to 2013, upon the attainment of age 65, there was a reduction due to a Social Security offset that was eliminated effective 2013. So the members of the supplemental system, their benefits do not change in retirement as they had previously. And these members are also eligible for the $200 per month supplement payable until the age of 65 for those who retire prior to 65. Any questions on that information? Okay. So the next two slides are just a summary of the participation of each of the systems. As you might expect, since the plans are frozen to new participants, the total count has decreased year over year. And the one thing I would point out is that we are down to 20 active participants in the fire and police plan. So most of the bulk of the members, as well as the bulk of the liabilities, the value of the benefits are associated with those who are no longer in employment.
And these are January 1 numbers?
These are July, so the plan year, the fiscal year is July 1 to June 30. So this is as of July 1 of 2018. All of the information, as well as the financial information, will be as of July 1 of 2018.
I think earlier Ms. Moser
I'm
said
going to double check.
21.
I'm making a note right now to check the fire and police.
Yeah, so these, I would tend to, so for actuarial purposes, the count can be off by one or two, depending on when we receive the information. So for example, we might receive the reporting of a termination of a retiree after the actual date that it takes place. So we have a snapshot as of July 1, so that might result in a small discrepancy in the head counts.
Well, her number was higher, so it's not, nobody could
yes.
get added.
Yeah, I understand that, but there are often small discrepancy in the head count, and that will be trued up the year after. We consider them actuarial gains or losses. Actuarial data is not always 100% accurate, but it's something that we true up on an ongoing annual basis. Similar for the supplemental system, we see that the overall head count has decreased with the active participation down to 16. Again, the bulk of the participants as well as the liabilities are going to be associated with those members who have already left the city's employment and have generally retired at this point. Any other thoughts or comments on the summary of participation in the plan? Okay, on slide 9, just want to touch on a few of the key actuarial terms that we will be referencing. First, with the actuarial value of assets. So the actuarial value of assets differs from the market value of assets. The market value of assets is the number you might see if you opened up a trust statement. That is the value that is reported for most purposes. But the actuarial value of assets you can think of as a 5-year average of market values over the past 5 years. We use this average in order to smooth out some of the fluctuation in the market, and hopefully by doing so, smoothing out the contribution requirements year over year, giving you a little bit more of a known pattern of contributions. So any gains or losses are deferred for a period of 5 years and then recognized over that period. So we'll see if the assets have performed better than we have anticipated. We'll defer some of those gains to future years, and conversely, if assets have performed worse or not as well as has been anticipated, we'll defer some of those losses, and you'll get a benefit of that. We'll review that in a little bit more detail. The actuarial accrued liability is the present value of benefits that have been earned to date. So we take a look at all the benefits that have been earned and that are payable as of July 1, 2018, and we present value that. Or another way to look at it is, what is the amount that the city might have to pay if they wanted to settle these liabilities? If you wanted to be done, payout as a lump sum or a one-time payment to these members, as opposed to the stream of payments that they're due for the remainder of their lifetime, what would that value be? So that's what the actual accrued liability is. Any questions on either of those two terms? Okay. The unfunded actuarial accrued liability is just the difference between those two measures. What's the deficit or what's the surplus of the plan? And another way of looking at the financial health is by dividing the assets by the liabilities. And that's what we refer to as the funded status or the funded ratio. So that's a percentage. If you have $80 million in assets and $100 million in liabilities, then the funded status is 80%. Just a quick way of understanding the financial health of the plan. And the actuarially determined contribution is the amount that, as the actuary, I calculate and recommend to you to make on an annual basis that will fund the plan for all future benefits. Obviously, there are a number of benefits that will be paid from now until the last participant has received their benefit. You're not going to pay for that all up front, but you're going to pay for that, fund some of those benefits now and into the future. So we come up with an annual calculation based on both the assets and liabilities and what we expect to be earned from the active employees to cover those benefits in the future.
Can I ask a question about that?
Sure.
So you say that's assuming that we hit whatever our expected return is, and people die when you expect. This is the amount that will, the contribution that will get us to fully funded over like a 7 or 10 year period?
Actually, it's over the course of the plan's lifetime.
Over the next 30 years?
40, 50 years. So it's, while it's a calculation, it's a moving calculation. So for example, as you mentioned, if the plan's assets has losses, that contribution is going to be higher than we would have anticipated 10 years ago. So, and as we move through the presentation, you'll see in the appendix I included some projections that we did 5 or 6 years ago. Projections have a host of assumptions that are built in. The one thing we know is that the assumptions typically don't come true. So there are going to be differences from what we assume to what is actually experienced.
And at that point in time, does your assumption mean that you'd be contributing that same amount every year for, or do you have that actuarially determined contribution as you have a different amount every year out into the future?
Right, so the contribution is going to change, and it could increase, it could decrease depending on the performance.
I know the actual one for each year, but when you make the calculation today of whatever that actually determined contribution is for 2018, are also part of that calculation projecting out all the future contributions? And are all those future contributions the same number, or in your model is different every year?
Yeah, so if we were to do that projection over the course of time, it would be different every year.
Because, I mean, you'd have to do the projection because you said this is the amount
I don't think you're hearing him. I think he's asking that number that you have, if the assumptions stay the same, that would be if that was the actual outcome, that number would be the same until the estimated termination of the plan.
It would actually be different. So what might be easier to
because you said it's the amount to contribute to fully meet the benefits over the whole lifetime. So in your model, you'd have to project whatever that contribution is for the full life of the plan.
Right. So it's not a flat amount.
So if you had you could have this, I guess, would be a table you could show us every year of what the assets, liabilities, funded status, and the contribution is. I guess, indefinitely.
Yeah, actually, if you turn to the appendix, this is akin to something that we did 5 years ago. And this is on pages 23 and 24. And this is something that's probably prudent to do every 5 or 6 years as circumstances change, as the economic environment changes. So we did this projection back in 2013 of the contributions as well as the funded status, the benefit payments that were anticipated, and this is an assumed investment return. So we assumed that on an annual basis, the plan's assets would earn 7.5%. Likewise, we assume that the liabilities would grow or decline in line with our assumptions. And even with those assumptions being met in this projection, you can see that the contribution pattern does change. And this is just showing, for a 15-year period, you can imagine over a 40 or 50-year period, the contributions could fluctuate even more. So, for example, if we look at fire and police, we anticipated that the contribution for the year beginning 2018 would be $6.3 million. So that's on slide 22. If you look at the 2018 column, the second row, back in 2013, based on the assets in the plan at that point, the liabilities associated with the members that were in the plan at that point, and what we assumed would take place over the 5-year period, our estimate of contributions would be $6.3 million. But when we fast forward 5 years from now, the contributions are higher due to asset performance as well as interest rates. Well, we use a stable interest rate for this system. We use 7.25% both for the investment return, the assumed investment return, as well as for measuring the liability. So that's pretty standard practice for governmental plans.
To use the same number?
To use the same number, and it's not directly based on market rates.
So leads me to a good question. 7%'s probably too high for both. Why would we use that number?
So this,
I think we're if you're using 7.5 or whatever percent, we're underestimating the value of the liabilities by a lot. I mean, the real discount rate for 30 years is much lower than that.
Yep. So for corporate plans, we use something much less than 7.25%, and it's actually based on the market, so it fluctuates year to year. Right now, we're using something closer to 4% for corporate plans. For governmental plans, the practice is to use the assumed rate of return because you don't have the same risk associated with the liabilities of a governmental plan as you do with a corporate plan. The assumption is, and I know it's just an assumption, that a government is not going to go belly up, so that you can comfortably assume that the asset return is a better proxy for how you can measure the liabilities as opposed to a discount rate that would assume a lot more risk associated with the assets of the plan.
To his point, though, I mean, you're using 7 on a governmental and 4 on a corporate. I tend to agree with him that 7 is probably on the high side, particularly in a city like the city of Portsmouth. You've got so much of the land that is not being taxed.
Yeah. So when this measure, the 7.25 assumed rate of return, was developed, it was not developed in a vacuum. So when we started working with the plan back in 2009, we were at 8%, which obviously is even more aggressive than the 7.25% that we eventually settled on. And when I say we, I'm not talking about John Hancock. These assumptions, specifically the rate of return assumption, is an assumption that is set and owned by the city and the board. So the 7.25% was not looked at in a vacuum, just looking at the city of Portsmouth's plan, but also in relation to other governmental plans, not only in Virginia, but throughout the country. And I don't want to speak on behalf of the board or the city, but my recollection was that 7.25% was thought to be relatively conservative when you look at the universe of retirement systems, governmental retirement systems. And that's also in conjunction with what we can think of as a reasonable rate of return on the assets.
And can you use 7 3/4 to calculate? 7 1/4. Can you use that number to calculate the lump sum to pay out the beneficiaries?
To the individuals?
Yeah.
So the
'Cause if you can use 7 1/4, we should just pay it all off right now.
So, okay, so you're talking about if you were going to settle the liabilities, like...
As you said earlier, the actual determined liability. If you're using 7 1/4, we got an arbitrage there. We can.
Yeah, absolutely. So if you were to go to the market, so many corporate plans, when they are ending their plan or terminating the plan, they will go to an insurance company, purchase annuities, and that's using market rates, and that's going to be something closer to 4%. So you wouldn't be able to go to an insurance company and get, be able to settle these liabilities at 7 1/4%.
So the value that we always look at for the liabilities is not a real number to me. Then we should look at whatever the economic value of the liabilities is to know what our real funded status is. The market value of the assets and the market value of the liabilities.
So I don't want to speak on behalf of anyone, but I think some of the concern...
For reporting, we can use whatever
Okay.
looks the best.
Yes, okay.
But I think as the board, we should know what our real sort of deficit is.
So how
I
have
think
we-
this, and I'm not sure who was raising those questions, but it's a real sort of hot topic in the government pension sector about how you discount the liabilities, particularly vis-a-vis what corporate plans are doing. But I think Andre kind of hit on some key points on the differences between how governments account for pension plans versus corporate plans, and the fact that government plans really can't go bankrupt. I mean, that's the rationale that's typically given for using a long-term expected return for discounting the liabilities. But whoever was raising those issues raised the good point about sort of the economic value versus what's required from an accounting perspective, and I think that's spot on. If we think about what capital markets might provide over the near term, I think 7 1/4 might be a little bit challenging. But as we look out over 20 and 30 and 40 years, which is the expected life of the pension plan here in Portsmouth, and even longer, we think that 7 1/4 is probably reasonable over that multi-decade period. I will say that over the last really kind of 10-15 years, expected rates of returns among government pension plans have been coming down. And even if we just went back 5 years ago, I would say the average was probably right around 8%. Since then, those numbers have come down, and the average right now is probably right around 7%. So 7 1/4 is reasonable from the perspective of what other plans are doing, but clearly the trend has been to reduce expected returns, which has the impact of increasing your liabilities and then increasing your cash contributions required from the sponsor. So there's a lot of factors at play, but we would completely agree that there's a sort of a disconnect between the accounting and the economic realities for government plans.
And just one follow-up. For accounting, use the most aggressive rate we can and support, but we still should have an idea for planning purposes to talk to council of what the real economic status of the plans are.
It should be arranged. Actually, that translates to my next question. I see that we're still using the IRS statistical mortality rate. In the insurance business, I know there is a difference in the fire and police population regarding the general versus the general population, since we have a plan that is specific to that, which would actually make our numbers look better. Why aren't we using those numbers?
So this also goes back a number of years. At that time, the board was trying to figure out ways to increase the contributions using the levers that they could. And one of those levers was around the assumptions that are used to develop the liabilities, specifically the mortality table. So if we use the mortality table, that would produce higher liabilities that would increase the contributions in the short term. And that was also prior to the obligation bond that was floated, and when the plan's funded status was in much more dire straits than it is now.
And that's when I remember when we voted on bringing a discount rate down from 8% to 7.25%. And one of the main things we were looking at is the city, whatever, they're going to have to make up that difference if we drop it so far. So we were also looking at that when we decided, because people talked about 6.5, 6 or whatever, and we feel like it was just too much at one time for the city to start, raising the arc that much, that quickly.
But to be clear, there is nothing that's required by the city to contribute. That term is misleading. These plans don't have to be funded at all, right?
That's probably why they changed.
We
the
want
acronym
them to
from
be
ARC
funded, but it's not. It's nothing's required as far as contributions.
Yeah,
Take it from the actual side, or?
Yeah, that is the case. My understanding is that the city has had a policy of contributing the actuarially required, or now it's the actuarially determined contribution. And my recollection is the board felt like the levers that they could pull to increase that contribution was around the assumptions. A lower discount rate, more up-to-date mortality table would increase the liabilities, therefore increasing the contributions. If we go back to 2012, 2011, when the city's funded ratio was 37%, what we saw was a significant decline in the asset base to the point where we thought we were going to be in a pay-as-you-go situation. And prior to the obligation bond funding the plan, there was serious concern about the money just running out. So that was a way to increase the contribution within the levers that the board could control.
So how have we historically measured up to the 7.25%? I mean, how do we look over, say, the last 5 years?
Yeah. So one of the things that I always look at, and I apologize for us having to jump around, but if you go to page pages 12 and 13, what I look at is the market value of assets versus the actuarial value of assets. And as I mentioned before, the actuarial value of assets smooths out the gains or losses. So like a gain would be when the assets return over the 7.25, and the loss would be when it doesn't meet that threshold. When the actuarial value of assets is greater than the market value, that means over the 5-year period that you haven't met that return of 7.25%. So historically, the 7.25% over the past 5 years has not been met.
So Andre, just back to the discussion on assumptions. I mean, it is, as you mentioned, I know it's up to the city and the board. We take direction on what we're utilizing there. So, the board, I guess, and the city or whomever can decide to have a conversation about the assumptions. Do they need to be revisited? Would you like us to be part of that conversation, provide more detail, et cetera? So, that's what's being utilized.
Okay. I was just going to say, the assumption of 7.25% is also going to be based on your asset allocation, right? So if you're in 90% fixed income, you probably can't support 7.25%, but if you flip it and you're 90% equities, you can support 7.25%. You're obviously going to have a lot more risk associated with those investments. So as allocations are changing, there may be a more merit for reviewing that investment return assumption.
Does the city get audited on those assumptions? Because we for corporate our auditors look at that and we have to provide support for how we arrived at that number?
For the city, it's, as Andre mentioned, there's certain governmental governmental accounting standards that we have to work within. As long as we're working within those assumptions, our annual audit is going to, say, look at what the assumptions are. They're within the parameters that GASB requires, and use the numbers. However, as CFO, and listening to this conversation, it's piqued my interest that we're saying that the accounting and the economics are significantly different, because as we know, as a retirement board, we've been over recent years, probably since the pension bonds were issued, talking to the city council about what the real liabilities are. So if it's different, I would be interested in in the board having a conversation, maybe of what should our assumptions be. 'Cause it sounds like we may have some misses on both sides. Again, I'm new to this, but I don't ever like to hear that there's a difference between, I guess, reality and accounting, because accounting should be reality. For purposes of making sure that we're keeping the system funded, adequately, and in addition to that, because we have the pension bonds, we do have the eyes of the rating agencies more closely on us, because in addition to making those required contributions that you're seeing that run around $9 million a year, and when we finish the study, you'll see that's going up. We're making an $11 million. The city's making $11 million a year debt payment. So so we're the rating agencies and our investors are want to make sure that we're keeping the system sound.
Can you guys calculate, based on the projected cash flows and the duration of the liability, what you would assume for the economic discount rate?
Yeah.
Does Greystone, do you have a file of what our liabilities are? Do you ever look at that?
We do have the cash flow information from Hancock. Yep.
Okay.
I mean, I think the dead giveaway is over the years is if you see our funding status going down, then we've not met that discounted rate. I mean, it's pretty much what you can say, right? I mean, if it stays steady, then you're hitting it. If it funding status goes up, then you're beating the discounted rate.
That is definitely a contributing factor. But even if we go back to those projections at the back of the report, you can see that, whenever we do a projection, we have assumptions, and we assume those assumptions are going to be met. Even under those conditions and circumstances, we saw that the funded status was going to decline, and that was largely because there were so many benefit payments that were being paid, and it was assumed that over time the assets would catch up with the liabilities. One thing that's important to know is that and maybe we should just, many of these issues I was going to touch on during the course of the presentation. So if we don't mind, maybe we can just get back to the presentation and I'll touch on the issue that I was just going to mention. Okay.
Hey, Andre, before you do that, can I just make one more comment about sort of the line of discussion that's been had here? So with the new relationship that's in place and the new contract here, one of the first things we want to do is what's called an asset liability study. So forecast out over time what those liabilities look like and what the assets are going to look like over the next, call it 20 years. One of the things that we can do in that study is to change what discount rate we use. So we can go from 7 1/4, we can knock it down to 7, we can knock it down to 4, and show you sort of more from an economic perspective what those liabilities look like. We'd also show you what kind of the cash contributions would be under those different scenarios too, because to the extent that, basically the biggest impact that the discount rate has is going to be how soon the city is going to need to kick cash into the pension system. So the higher the discount rate, the lower the cash contribution, but it's going to be over a longer period of time. And then the lower the discount rate, the more immediate and higher sort of the cash contribution. So that's one way to think about it. But in that study, we can look at a number of different scenarios and see what happens and see ultimately where the board's comfortable in moving to. And then it helps us to figure out what the right asset allocation strategy is. And although it hasn't been said, it's been sort of touched upon with the fact that we haven't been able to hit the 7 1/4%. The 7 1/4% is a sort of a point estimate. We know in reality that there's a range of potential outcomes around that, and that range can be pretty big based on how aggressive we invest the assets. So recognizing that in any given year, 7 1/4 is probably not going to be the right number, but more likely there's going to be, it's going to be 7 1/4 plus or minus a pretty wide range, and recognizing that over single year periods, which is when you do your valuation, I think is an important consideration too. So.
Can your analysis include other rate of returns from other self-funded retirement systems? I'm thinking of maybe Norfolk, Newport News, even VRS. See how we might compare with that. It sounds like 7 1/4 is the government standard right now, but I'd be curious.
Yeah, it's right around there. It might be, we'll look, but it might be around 7%. So 7 1/4 seems, reasonable, but it's certainly not overly aggressive, I don't think, based on what everybody else is doing.
Yeah, it's
we can certainly look at that.
7 1/4 is definitely in the range. There was actually consideration for going lower than 7 1/4, and there was a thought that the city doesn't need to be, on the most conservative end of the spectrum, but 7 1/4 felt like it was in the sweet spot when you compare it to other cities that have plans in a similar position. And there was a question about could we estimate the liability based on more economic drivers, and this plan has a duration of about 10. So if you assume a 300 basis point discount or decrease in the discount rate, then we're looking at a 35% increase in the liabilities in comparison to what we're using in this presentation. So that gives you a high level understanding of what the increase might be if we were using something closer to what corporate plans use.
Maybe it's 4 1/4 or something like that.
Yeah, so that's what we're seeing today, and that's even in this rising interest rate environment. That's what corporate plans are using. Okay, I think we were on slide 10. And just describing what goes into the actuarially determined contribution. There are two components of the contribution. One is the normal contribution or the normal cost, and that is just the present value of benefits that are earned in a given year. So that is associated with active employees. What is the value of the benefits that they're earning due to the additional year of service based on their compensation? And because there are so few active employees, that's the smaller component. The much larger component is the accrued liability contribution. That is an amortization of the difference between the assets and liabilities when we measure them on the valuation date of July 1, 2018. So we look at difference in the assets and liabilities, amortize that over an 18-year period, similar to how you might pay for the mortgage on your home. You amortize that over a 30-year period instead of paying it in one lump sum. One thing to note is that we phase down the amortization period by one every year. It started at 30, the amortization period. It is now down to 18. In 2019, we'll amortize that deficit over a 17-year period. 2020, it'll be over a 16-year period, and so forth. So you can imagine, as the time period gets smaller and smaller, you're going to be amortizing over a shorter period of time. The funded status will improve if the city is following the recommendations that we put forth, but the contribution pattern can become a lot more volatile because of that shorter amortization period. Some of the key assumptions, we've talked about the 7.25%. The other key assumption is the mortality table, what we assume for longevity for each of the participants. And I'll touch on that a little bit more on the next slide. And as of July 1, 2018, we haven't been made aware of any cost of living adjustments. So we are valuing the benefits as they have been paid for since 2017. That's what we're using for our 2018 valuation. So the IRS updated their mortality table for plan years beginning on or after 2018. This table was based on a study that the Society of Actuaries completed in 2014. That table increased the expected longevity of participants. We adopted a similar table for accounting purposes, what goes into your CAFR, back in 2015. The policy has been, for funding purposes, determining contributions, to follow the table that's dictated by the IRS. So for the 2018 valuation, we're now using the table that's been published by the IRS for 2018. Assumes longer longevity, therefore increases the liability because members are assumed to receive their benefits for a longer period of time. For the fire and police system, the liabilities were increased by 2.2% and 3.4% for the supplemental system as a result of the mortality table being updated. Any thoughts or questions on that? Okay. Slide 12 is a summary of the market value versus the actual value of assets for the fire and police plan. So, as I noted, the one thing that I always look at is how the actuarial value compares to the market value. You'd prefer to see the market value of assets higher than the actuarial value of assets, because that would mean that the investment performance has been positive in terms of your expectations. We can see for the past 3 years what the rates of return on the actual assets have been, 1.6%, 10.6%, and 4.66%. And that is exactly why we use the actuarial value of assets, to smooth out those gains and losses so that you have a more of a known pattern of assets, and hopefully produces a more of a known pattern of contributions year in and year out. For most plan sponsors, I think the bane of their existence is the fluctuation and volatility of contributions and not being able to budget for those contributions. So the actuarial value of assets allows for us to better budget for those contributions. Similar story for the supplemental plan. Since the plans are invested similarly, the returns on a year-to-year basis are very similar. Thoughts or questions on the actuarial value of assets versus the market value? Okay. On slide 14, a summary of the actuarial value of assets versus the actuarial accrued liability. Again, the accrued liability is just the present value of the benefits and what, in theory, you might be able to pay out in order to settle those liabilities. The funded status has declined year over year. Again, we expected that to a certain degree based on our projections. The other reason that the funded status has declined, especially from 2017 to 2018, is because the return on assets hasn't been what we anticipated. and there was an increase in the liabilities as a result of the change in mortality table. So those factors are the primary contributors to the funded status decline year over year. Similar scenario for the supplemental systems. Small loss on the asset value, liability loss attributable to the mortality table update, and that brings us from a 76% funded status to a 72% funded status for 2018. One thing I want to point out is with respect to the discounting of liabilities, I know we've had a lot of discussion around the 7.25%. GASB actually does require you to use a hybrid rate if there is an anticipation or projection of assets running out. So you can use your assumed rate of return for all the years that you project that the assets can cover the liabilities. If we project that the assets will not be able to cover the liabilities at a point in time, at that point we have to use a fixed income rate of return, which would be a lot closer to the 4%. Because of our projections, and obviously we assume that the systems will be funded via the contributions, we don't anticipate that the assets will run dry. So for that reason, we use the 7.25% throughout for discounting of the liabilities. Page 16 is a summary of the suggested, the annual actuarially determined contributions versus what the city has actually made. The city has made exactly what has been determined on an actuarial basis. That amount was $6.2 million in 2016, increased to $6.4 million in 2017, and we're looking at $7.2 million for the fire and police system as of 2018. As the liabilities have increased as associated with the asset losses as well as the increased liabilities due to the updated mortality table, that's translated to the contributions on an annual basis as well.
So I can understand the actuarial model a little bit. So
Sure.
I'm assuming you use the actual, the ages of the people that are the primary contributor, age and sex, and then of them which have a designated successor beneficiary and the age and sex of that beneficiary, and you run the numbers then.
Absolutely. So we have the primary recipient as well as their beneficiary. The model applies the mortality table to both of those individuals and assumes that there will be a stream of payment for a period of time.
So it wouldn't be hard to project, here's the number that we expect to drop out of the system every year.
So it's based on percentages. So each individual is assumed to receive some benefit until the age of 120. That's when the mortality table stops. That benefit gets very, very small because of the likelihood of actually surviving till that point in time. Mm-hmm. So it's not that we don't necessarily base the liabilities on their expected longevity.
It's not a year by year loss.
It's not exactly. We assume that there's a probability of payment for each year out until the age of 120. That payment gets smaller and smaller because there's less of a likelihood of receiving it.
For instance, for 18, it'd be 100% or 99.9%.
Something very high. Yep. Any other questions or thoughts? Contributions for the supplemental system, it's $1.8 million in 2016, closer to 1.9 in 2017. In 2018, we're close to 2.2. Again, the increases due to the updated mortality table primarily, as well as assets underperforming our expectations. So I'll just take a moment to just throw out, I know we've been talking about the economic value. would there be any benefit to not only understanding what the liabilities are, but what the associated contributions might be on an annual basis under something closer to what we might use for a corporate plan? And what I look at where we are with the GASB, or the governmental funding rules, contribution rules, similar to where we were 15 years ago in the corporate plans. 15 years ago, for corporate plans, we used very similar assumptions. It would be liabilities were discounted based on a rate of return as opposed to market value. Plan sponsors had a lot more discretion in setting those assumptions, so in many instances, they were not market-based. I don't know that GASB will ever get there, but would it be helpful, give you a range of what those contributions might be if we were to look at something like what we might calculate under a corporate plan?
I would say yes, but Greystone just said with their asset liability study, they're going to be doing that, so I don't want duplicate work to be done. I don't know who is better served to do that work, Greystone or John Hancock, or work together on it.
Yep.
I don't want both of you doing the same thing.
That makes sense. We can take that back if that's something that the board sees as appropriate.
Can we discuss the range of cost, because the board will be approving the invoice?
I will tell you, for me to put together a analysis based on today's costs, that won't take me very long, so there would be no cost for that. It's always when we're talking about projecting things out where there's a lot more involvement.
Well, that's included with the Greystone mandate, I believe.
Correct, yep.
So they could do it for free as long as they have the cash flows,
right?
The liability cash flows. I think they're probably capable of doing it.
And we could certainly collaborate with Andre's team as well. So, yeah.
Okay, but if you're looking for some numbers based on where we are today, what would the 2018 liabilities and contributions look like if we were using something closer to what a corporate plan might be required to use? I can turn that around in a couple of days. I thought that might be helpful given where the conversation has gone today. But you can let me know, take that back. And
so as I understand it, Andre can do an analysis up to where we are, and Greystone is going forward in the analysis. Is that what I understood?
Yeah, so an asset liability study pretty much projects forward what the range of potential outcomes are, both on the asset liability side, and then you can look at other measures. What I'm proposing is you have these numbers today based on the 7.25%. What might it look like if we were to use something closer to what a corporate plan might be required to?
So that sounds like a bifurcate. That's the complete, as I understand it, and you all may. Andre can do based on where we are, and Greystone is going to give you some analysis going forward, some projections going forward.
So it's my understanding there's no cost to the plan to do that, then I would be in agreement that we would ask for it, yes.
Yes, I think it would be beneficial, and talking about government accounting standards, and we do tend to lag behind corporate standards. However, and we refer to that as GASB. GASB has over the most recent years has really started taking this on. So I think maybe what you were alluding to is we may quickly get to where that will be the government reporting standard.
Right.
Because I didn't just tell you, less than maybe 15 years ago, we were on GASB statement number 34. And that's since GASB began. And since then and now, we're up to the high 80s. So, and a lot of those standards have been on liabilities, pension liabilities, OPEB liabilities. So it wouldn't surprise me if very quickly the GASB tried to move in that direction.
And what I'm proposing is just changing how we calculate the liabilities, not necessarily calculating the contributions in line with the corporate plans. The corporate plans use a 7-year amortization period. I think we do everything else in line with GASB requirements. Let's just look at the liabilities based on market rates.
Yeah.
Okay, so I think that covers it for where we are today under current circumstances. I was going to turn to the COLA analysis, but before we do that, is there anything else with respect to the current results that folks want to discuss? Any questions, thoughts, comments?
Only other comment I have, going forward, can we see sort of the snapshot of these plans in aggregate?
Sure.
Just like maybe a 1 page of the high-level stats of both combined plans.
Absolutely. So assets, liabilities, contributions, just
Funded
high level.
status, that stuff.
Absolutely, makes sense.
I just wanted to go back real quick. Ms. Spivey had mentioned the $11 million debt payment we have for the pension obligation bonds.
Right.
But if my memory is right, we're still in a better position, the city having to pay than we were back before the bonds, because it seems like to me the ARC was right around 23 million back before we did that.
My recollection is around 18 million for the fire and police jumped out at me.
Right.
And when looking at what the required contributions would be added to the bond payment,
Right.
the thinking and the reality was, at least at that time, was that the total would be less than the ARC would have been without the funding. I believe a lot of the impetus behind doing the pension obligation bond at that time was the low discount rate environment. Arbitrage you can get if you're making the loan at 4% and you're assumed to return 7.25%.
And no doubt that the assets are higher now in the retirement systems. What I believe gets masked is we're funded by the city, and the reporting just shows what the required contributions are. The city is still having to come our tax base is still having to come up with that 11 million a year until the bonds are paid off. So I think it's important for that to continue to for that to hit some of the reporting that we do. Otherwise, it looks like that that was free money, what were the pension obligation bonds? 175 million. So yes, the systems started looking a whole lot better. And it was probably the right thing to do to get the systems in better financial condition. However, we don't want to forget that that the city had to borrow that money, and so our revenues, our city revenues, are still paying, are paying that debt off. So even though the retirement system looks a lot stronger, the city is still making the payments that it likely would have been making to meet the annual contributions.
Yeah, agreed. I think it was we're either going to be paying $25 million in ARC, maybe we'll pay $22 million in total of ARC and bond obligation, but don't quote me on those numbers, but the idea was in total the city would be paying less.
So can I just raise just one more issue from a process perspective here? So I think there's been a lot of great discussion around assumptions and liabilities and how you discount those for public funds. We talked about kind of how we can help guide that conversation from an asset liability study perspective. From a process perspective, we know that there's going to be an investment committee that's created or established, hopefully at the next meeting in November. given the sort of the weight and the impact of this issue, we would strongly suggest that we have discussions with the investment committee after it's created around these topics, discuss what all the issues are and the impacts of changing the assumption and thinking about liabilities maybe from a different perspective. And once that discussion and evaluation has been completed, at that point we would come to the board with some analysis and potentially some recommendations. From a process perspective, is everybody comfortable with that?
Sure.
Yeah.
Everyone
seems
agrees,
so.
Brian.
Okay, great. And then one final thing. A colleague of Jim and mine is also on the phone. Her name's Suzanne Lindquist. She's part of our OCIO group and does a lot of work in this space with modeling out liabilities. And so she's going to be involved in that process as well. But I just wanted to just introduce by name on the phone today, but you'll likely see a third member of the team, particularly related around the discussion that we're having today. So with that, I'll just go back on mute. Thanks.
Thank you. Back in February, I believe, we put together an analysis of what increases in benefits to folks who are currently in receipt of a benefit, how that would impact the financials of each of the systems. We refreshed it based on 2018 data, and page 19 is the beginning of at least the results for the fire and police plan. So in the first column, we have the assets and liabilities, funded status, as well as the contributions to get to certain thresholds based on the current provisions. So we had, as you've seen before, a funded percentage of about 70%. The second column represents what those liabilities and funded percentages would be if we were to provide a $75 increase in the monthly benefit for all members as well as any beneficiaries that are currently receiving a benefit. That increases the liability by about $6 million. Funded percentage drops from 69% or 70% to 68%. The contribution to attain 80%, whereas based on the current provisions it's $25 million, that increases by about $5 million to $30 million. And you can see what the results are for 100%. With respect to a codified COLA, whereas each individual gets a cost of living increase from now into perpetuity based primarily on CPI, that increases the liability by a much more significant amount because it's not just a one-time increase, but an increase for every year. The funded percentage decreases from 68% to 60%, pretty significant. And the contributions to attain the various thresholds obviously increases pretty significantly. To 80% goes from $30 million to $55 million, so we're talking about a $25 million increase.
Can you give me some background on the $75? How did we get to that amount? Why was that an assumption here?
If I might, it was a inquiry by a council member to add, and there was a series of discussions over a better part of a year. There were different subsets at different discussions, but it was always, I think the last series of discussion was $75 either for some subset of the committee, and then the analysis was done for the whole cohort.
I believe that figure came from our retired fire and police union.
Okay.
And that's what they were meeting with council with and asking for.
Okay.
Similar results on a smaller scale for the supplemental system on page 20. The liabilities from current provisions to the $75 increase go up by about $6 million. And for the codified increase, where we have increases on an annual basis, those liabilities increase by $17 million based as opposed or in comparison to the current provisions. You can see the associated contributions to attain certain thresholds associated with each of those prospective scenarios.
Andre, could you speak to the most recent subset analysis you did for, based on city council request, so that this board hears it, before we deliver it to city council?
Right. So we prepared some information that honed in on a subset of the $75 increase. This subset was just in relation to beneficiaries as opposed to any retiree, just looking at those beneficiaries of deceased members and providing them with a $75 increase. And thank you, Tom. And the numbers were more modest than what you see presented here. The increase for the fire and police system was only about $500,000, $560,000, and I also translated that into what the increase in the annual actuarially determined contribution would be, and about $50,000 increase on an annual basis in the contribution. And for the supplemental system, similarly, an increase of about $500,000 in the liability as of July 1, 2018, with about a $50,000 increase in the ARC. So we're looking at a much smaller subset of the population of folks who are currently in receipt of a benefit.
That's still increasing the liability by over $1 million.
In total.
In total.
Across the systems.
And the annual required contribution in excess of probably $100,000.
Just over $100,000.
Per year.
I think that was a compromise that they were looking at, saying that the widows or widowers of the retirement system, their benefits were already cut by 50% when their spouse died, that some of them were living almost at poverty level, and that $75 would really help them out. I think that was a compromise when they were going back and forth about $75 for everybody and then $75 just for that subset.
So in just some information for some of the folks that haven't been on the committee, on the board as long as others, there's no codified COLA, meaning there's no COLA as part of the provisions of the systems whereby folks can expect an increase. But there have been ad hoc COLAs in the past where the city will determine that a 1.5%, 1% increase is warranted to those participants who are currently receiving a benefit. I think there was some discussion around, well, let's kind of take this discretion out of it, or at least consider taking the discretion out of it. What might it look like if we codified it? And that's what the second scenario, third column is related to.
Right. Currently, City Council was considering that on a yearly basis as cash was available and paying it out of current funds rather than building it into the retirement system. And this is to see what it would be to build it into the retirement system permanently without having to make a decision every year.
And a bonus that was not considered in years to come, just one time.
And didn't automatically create a multiplier for the next year.
That's right.
And I believe what you may be referring to is what we've seen in the last couple of years, or what's transpired in the last couple of years, which wasn't necessarily an increase to the benefits, but a one-time payment.
Exactly.
So that brings a close to my prepared remarks. Any other thoughts or questions? Information you're interested in?
Anyone?
If I might, I did send electronically the PowerPoint presentation to each of you, and the one question I did not ask, and I've spoken to the city clerk's office. She is going to sent to Ms. Mosier the presentations from the board retreat, and then they can send that out. If anybody needs a hard copy, certainly let me know and I can get you a hard copy, but I've sent the electronic copy to you already.
And then I'll just add one additional note. So with regards to the variance in the active population in the fire and police plan, I believe it is related to, there's an individual that had a pending workers' compensation issue, and the classification on our system for that individual, and I believe your system was a little different on how we were picking that person up. That was at the end of July, so that's where that variance is. That's it.
Any other business? Need to have a motion to adjourn?
Motion to adjourn.
Second.
All in favor?
Aye.
Thank you.
Thank you.
Thank you. Thank you, everybody. Bye-bye.
Thank you, Brian.